What's going on, everyone, and welcome back to the channel. If you've been watching the market lately, you've probably seen the wild ride in Beyond Meat stock. It's a name that sparks strong opinions, a pioneer in the plant-based revolution, but also a company that's faced immense challenges. So, after a recent explosive rally, is BYND a stunning comeback story in the making, or a classic value trap? We're diving deep into the financials, the strategy, and the analyst opinions to help you decide. Let's break it down. Beyond Meat, ticker BYND, is a leading American food company at the forefront of the plant-based meat movement, dedicated to creating delicious and nutritious products directly from plants. Founded in 2009, its mission is to address global concerns related to human health, climate change, and animal welfare by offering an alternative to animal-based meat. The company's core innovation lies in its proprietary process that studies the architecture of animal meat and replicates it using plant-derived proteins, fats, and minerals, primarily from sources like peas, mung beans, and rice. Its widely recognized product portfolio includes flagship items such as the Beyond Burger and Beyond Sausage, which are designed to look, cook, and satisfy like their animal-based counterparts. These products are strategically distributed in the meat aisles of major grocery stores, as well as through food service channels, including restaurants and fast food chains globally, making plant-based options more accessible to mainstream consumers. First, let's set the stage. Beyond Meat is the iconic name in plant-based protein, famous for burgers that bleed. They rode a massive wave of consumer interest in sustainability and health. But that wave has crested. The market is now crowded with competitors, and overall demand has softened. The big question is, can Beyond Meat adapt and reignite growth? Let's get straight to the numbers, because they tell a tough story. In the second quarter, Beyond Meat reported revenue of $75 million. That was down almost 20% year over year, and they lost over $33 million. Looking ahead to Q3, they expect about $70 million in revenue. While that slightly beat very low expectations, the trend is clear. Sales are shrinking. The bottom line? Profitability remains a distant dream. Gross margins are thin, around 10 to 13%, and they're burning cash with high operating expenses. To stay afloat, they've had to restructure debt, which led to stock dilution, essentially making each existing share a little less valuable. For investors, the financial picture is undoubtedly the biggest red flag. So, what is management doing to turn this around? They're not standing still. Their strategy has three key pillars. 1. Global reshuffle. They're pulling back from costly, competitive markets like China to focus on Europe, specifically Germany and Belgium, where they see more potential. Future expansion is eyed in places like Japan and South Korea. 2. Product innovation. This is crucial. They're launching new and improved products like the Beyond 4 Burger and cleaner label Beyond Ground. The focus is squarely on better taste and better health credentials, like lower fat and even an American Heart Association endorsement. 3. Strategic partnerships. They're still working with giants like Yum Brands, the parent company of KFC and Taco Bell, and the McPant Burger with McDonald's, though some tests have been scaled back. The goal is to get their products in front of as many people as possible. Now, despite this strategic push, Wall Street analysts are largely skeptical. The overwhelming sentiment is caution, with many maintaining sell or underperform ratings. Why? Because they see the weak fundamentals, declining sales, no profit, and fierce competition as more telling than the turnaround promises. Which brings us to the elephant in the room, the recent massive stock price rally. So, what caused that spike? Was it a breakthrough product or a surprise profit? Not exactly. This rally was largely driven by a surge of retail investor enthusiasm and a classic short squeeze, where traders who bet against the stock were forced to buy it back, driving the price up even further. For analysts, this frenzy isn't based on a change in the company's core health, and many advise selling into this strength. Let's talk about the competition, because it's fiercer than ever. Beyond Meat isn't just competing with other vegan startups. They're in a war on three fronts. First, you have the direct innovator Impossible Foods. Their secret weapon is heme, a molecule that makes their burgers bleed and taste remarkably like real beef. They've captured a lot of consumer excitement and landed major partnerships of their own.
The second, and perhaps bigger challenge, comes from the established giants. We're talking about companies like Tyson, Nestle, and Kellogg. These players have massive advantages, decades of brand trust, and most importantly, they already have their products in every grocery store aisle. They don't have to build a distribution network, they just have to add a new product to it. And third, the market is getting crowded from the bottom up. A wave of emerging startups and store-brand private labels is focusing on niches like organic ingredients, unique flavors, or hyper-sustainability, fragmenting the market even further.
Now, let's talk about the biggest hurdle for Beyond Meat right now: profitability. Simply put, the company is not yet consistently making money. The numbers tell the story. Gross margins are currently thin, sitting around 10 to 13%. Why? The company has been grappling with production inefficiencies and has absorbed one-time costs from restructuring and even pulling out of some unprofitable markets. Operating expenses remain high, at around $41 to $43 million per quarter. This reflects ongoing spending to market the brand, invest in research and development for new products, and manage operational adjustments. So what's the path forward? Management is firmly focused on cost cutting. This means exiting less profitable markets, streamlining operations, and optimizing their supply chain to become more efficient. The official goal is to achieve EBITDA profitability by the year 2026, but this goal comes with a big asterisk. It's contingent on stabilizing their revenues and improving those margins in what remains a brutally competitive market. And now about the challenges, because you can't understand the opportunity without them. First up, regulation. Beyond Meat faces ongoing scrutiny over how it labels its products. Could they be restricted from using terms like burger or sausage? It's a real possibility, and any new rules could hurt brand recognition and consumer perception. Then there's the issue of consumer adoption. The initial boom has softened. Why? Price is a big factor. Plant-based meat is often still more expensive than traditional meat. And let's be honest, some consumers just prefer the real thing or are now curious about the next wave of alternatives like lab-grown meat. This leads directly to our third risk: intense competition. Beyond Meat isn't just competing with Impossible Foods anymore. Every major meat producer, like Tyson and Perdue, now has its own plant-based line. The market is crowded, leading to price wars and pressure on margins.
Okay, so with all those headwinds, why are investors still paying attention? Because the long-term opportunities are still massive. The biggest one? Sustainability. Concerns about the environment and personal health aren't going away. In fact, they're growing. Beyond Meat's core mission aligns perfectly with the global shift toward sustainable eating. If the company can double down on cleaner ingredients and transparently market its environmental benefits, it could win over a generation of conscious consumers. And this isn't just a niche trend. This is about capturing a share of the global food market. Out of the 9 major firms covering Beyond Meat, a staggering 7 have a sell or strong sell rating on the stock. The other 2, they're only suggesting you hold. Here's the kicker. There are currently 0 buy ratings. Not a single analyst at a major institution believes this stock is a good investment right now. But it gets worse. The average 12-month price target they've set is around $2.07 per share. Given that the stock is trading higher than that as we record this, analysts are collectively forecasting a significant downside from current levels. Firms like Mizuho, TD Cowen, and BMO Capital have targets in a tight low range, mostly between 80 cents and $2.50. That's a vote of no confidence if I've ever seen one. Analysts are pointing to a perfect storm of problems: ongoing deep losses, the company is still not profitable; equity dilution, they're issuing more shares to raise cash, which makes your existing shares less valuable; weak fundamentals, the core business model is struggling against intense competition and shifting consumer demand. Now, you might have seen the stock jump on a random surge. We've all seen meme stocks pop. But analysts are issuing a strong warning. These price spikes are completely detached from the company's actual financial health. They are driven by retail trader sentiment, not by improved sales, new contracts, or a path to profitability. The advice is to not be fooled by these temporary rallies, as the underlying challenges remain massive. That's our breakdown of Beyond Meat. This is a cautionary tale of a once high-flying stock that has lost the faith of Wall Street. Have you invested in BYND? What's your take on its future? Let us know in the comments below. Don't forget to like and subscribe for more unbiased market analysis. Thanks for watching.